If you're a self-employed business owner, things can get pretty challenging. You're wearing all of the hats. You're the rainmaker, you're head of marketing, and you're also the complaint department. And hopefully this last one is the least of your worries. Now you've decided to take all of that social media influencer money that you've been making and buy yourself a house. The mortgage application process can be pretty challenging for self-employed homebuyers, especially when it comes to providing documentation. When applying for a mortgage, lenders will look at your credit history, the amount of money that you have, the type of property that you plan to purchase, and your ability to repay the loan back. Go figure. Your capacity to repay the loan is typically determined by your income and your employment history. This step can be complicated for those of us that do not have a traditional documentation of our income and employment. Depending upon the nature of your self-employment, you may have income from freelance work, side job, gig work, contracting, or a business that you actually own. To determine how much you're able to borrow, lenders will combine all of your sources of income together into your total taxable income. Lenders want to see that the amount you earn from self-employment is steady, or even better, increasing over time. For home buyers with a traditional job, pay stubs and W-2s serve as proof of regular income. But for self-employed individuals, income records could include 2 years of personal tax returns, Schedule C, 2 years of business tax returns, including schedules, year-to-date profit and loss statements, balance sheet, and once you provide your income, your lenders will evaluate your debt-to-income ratio, which is the percentage of your gross monthly income used to pay your mortgage and other debts. This ratio is calculated based on your income after expenses. This can be challenging for self-employed borrowers. As a self-employed taxpayer, we always want to deduct as many business-related expenses as we can because it reduces our taxable income and your tax bill. But the flip side is less taxable income could create a higher debt-to-income ratio based on the lower amount listed on your tax documents. This is important to keep in mind when you're preparing to buy a home. Regarding employment, most mortgage lenders require at least 2 years of consistent self-employment in the same industry, so it's important to keep good records of your work history. The following documents can be used to show consistent self-employment: letters from current clients, signed CPA statement, business license if you are a business owner, and proof of insurance for your business. If you haven't been self-employed for 2 full years, lenders may allow and accept W-2 from a previous employer in combination with the documents I mentioned earlier. As you move off and start searching for the right home, it's important to work with a team of professionals who can help you make informed decisions along the way. They'll be an invaluable resource in getting you through the process as a self-employed home buyer. And if you'd like to join me for a webinar where we discuss in detail home buying for the self-employed, send me a message and I'll send you the link. If you have a question about selling your current home or purchasing a new one anywhere in Boston South Shore and in Eastern Massachusetts, give me a call. I'd love to help you. I'm Jim Aldred.